You are muted, my friend.
Checkity check check. Can you guys hear me okay? What's going on, everybody? Hello, hello. Welcome, welcome, welcome. So our CEO, Gaven, who's usually the one doing these lives, he decided to go traveling. And so he's with his family right now. And I'm going to be taking these lives over for about the next 3 weeks. You guys are going to be with me talking about whatever the heck comes to my mind. Today I'm gonna cover something that I'm like super duper passionate about, and that is macroeconomics. And for a lot of people, this can be a very boring subject, but in the world of investing, it's one of the most important subjects. Is to actually understand how like the economic machine works, what drives markets, how investors make money in markets. And at the end of the day, it's completely a liquidity game, right? Can you close that door too? Beatrice, can you close the door? Okay. The team is working on lights here. All right. Let's see. But just real quick, put in the comments, how are you guys doing? How's everybody getting along? Who here went to the 2-day event that we did? Who here went to the 2-day event? I can't see how many people are watching right now, but just want to see who's here. I see Jay Morton. What's up, Jay Morton? You were at the 2-day event. Have you seen us before the 2-day event, Jay? Or did you come from the 2-day event? Leroy Davis. I know that name. We got Golden Alchemy Meditation in here. Awesome. Sweet. Well, welcome, Jay. Welcome to the collective here. Hopefully by the end of this, you're one step closer to being a smarter investor. Before event. Cool. All right. But as I said, we're going to focus on some macroeconomics. And it's kind of like the title of this video. This is a $1 trillion setup, right? And remember, when we're investors, we're just always positioning ourselves for waves that are coming, the waves of innovation, right? 20 years ago, you could have gotten into Apple, Amazon to bet on the wave of how much they were going to grow, how much people were going to use their product. You could have bought a house, right? And houses grow in value, right? You always invest for the long term. And one thing that is always guaranteed long term is the fact that the US government is going to print more money, right? They're going to always print their way out of every problem that they have. And we're kind of, as Nick covered on the 2-day event, right? We're kind of in the midst of this fourth turning where we're in this kind of winter time about to potentially erupt into a spring, right? And we have AI and we have all sorts of new technology, new innovation, things that are going to reduce prices for all of us, because as technology becomes more productive, as it becomes cheaper, as it becomes more efficient, the cost of everything comes down, right? Like TVs used to only be owned by the wealthy, and now everybody can get a TV for like $100, right? Same with telephones and same with the internet, and now it's a mass product, right? So while we have this crazy inflation problem, we also have a very big deflationary force coming ahead. And as Billy Carson covered, we kind of have this new post-labor economy that is essentially in the midst of blossoming right now, right? Like the next 5, 10, 15, 20 years are all going to look different from the last 5 years, right? From today. 10 years from now is going to look really different than five years from now, right? Because we're going to continue advancing. Now, as investors, as people who earn income and choose to invest that income, So hopefully we grow our net worth, right? It is so important for us to understand how this game works. Okay, now I've been studying it diligently for the last 5 years, right? And the thing that I always go back to is the macro, the big picture, right? It's actually super easy to invest. It's not hard. It's not difficult. It's difficult to get it right, but in the grand scheme of things, it's not difficult, right? You just got to zoom out. You got to see the big picture. And that's what we're going to look at today. And then I'm going to show you what's going on right now and where the smart money is getting positioned for a crazy opportunity worth $5 to $7 trillion. That's how much new liquidity is going to come in the market. And remember, the way that investments work is and this is old school, right? Supply and demand. You have more buyers, right? You have more demand, prices go up. You have less people buying, more sellers, prices go down, right? So as the government prints more money, right? And there's only a certain finite amount of Bitcoin or ETH or houses or S&P 500 stock, right? The value will just go up to mirror the supply, right? When the supply of money increases, but fixed assets remain constant, like gold, right? They're just going to kind of mirror that value. That's why when you look at 100 years worth of data, you see that everything has gone up in value. It doesn't matter what it was. I mean, if it was a solid investment, it would have gone up in value. But let's get into this real quick. So I'm going to go ahead and share my screen. We can start. So let me share this screen here. Can you guys see my screen? Throw it in the chat. Yeah, can you see that? Just a nice, pretty open green field. My background. So let me carry this over. So does anybody know what this chart is right here? What is this a chart of? Throw it in the chat. I want to see who's paying attention. I mean, it says it on the thing, but let's see if anybody knows it. What is this? Let me put on the log. No one? No one knows? Leroy says Amazon. Nope. Nope, but thank you for participating. Inflation. That's good. It's really good. Not global liquidity, Jordan. Just U.S. liquidity. So this is the M2 money supply, which M2 just basically stands for the cash that is in society, okay? The cash that is in society. And you can see here from 1959, this has been nothing but just going up, right? It's been going up like crazy, right? You can see this really big spike that happened right here in 2020, right? Where we had to print $6 trillion out of thin air. And then we continued printing, okay? And then something happened right here that kind of changed the, yeah, good job, the devaluation of the dollar, money stock. Yeah, so anytime that we have more money in circulation, we have, as I'll say Golden Alchemy Meditation said, you have more inflation, right? Because you have this, you have more dollars and you have the same amount of land, you have the same amount of assets, gold, stocks, right? Like that doesn't get printed the same way that money does. And so then if we look at, so then if we look at the chart of the S&P 500, right? You see a very similar trend, right? Now, don't get me wrong. There's all these in-betweens that are caused by, wars and depressions and recessions. But for the most part, right, the S&P 500, when you really zoom out, this is about 75 years, right? For the most part, it's only gone up, right? And sometimes we see liquidity take a little bit of a hit and we see pullbacks. But again, for the most part, it goes up in value. Okay. Now, what drives the economic machine, right? What drives the economy, whether you're doing better or whether you're doing worse, right? And the economy, that thing is interest rates. Okay. And it's this chart right here. Okay. This is the interest rate on the 10-year yield or the 10-year bond, right? Because remember, the US, to fund itself, it has to sell you debt, right? It has to sell you debt. They're saying, you know, way back when, you know, they would say, hey, I'll sell you this note. I promise to pay you 4% per year. You buy it from me, and I'll give you the full amount of money back in 10 years. But every year, I'm going to send you a interest check, right? So you have a return on your investment. And hey, I'm the U.S. government. I'm the closest one. I'm the closest one to the central bank, right? I'll guarantee that we'll never default on this. Okay. So then what kind of happens is, you know, when you're looking at the economy, right? What is the economy? It is goods and services. What are goods and services? It's you being able to go to your job to get a check. It's your business having customers to sell to, right? It is goods, abundant goods, right? People buying, consuming, going out on vacation to support travel industries, buying cars, buying houses, right? Anytime people buy big things, they usually don't do it in cash, right? They do it with debt. And that debt comes from your bank. And your bank gives you a certain interest rate. And interest rates are controlled by the central banks, by the US government, right? So whenever we see interest rates go up, like we did basically through 2021 all the way to now, right? Things in the economy tighten. And when things in the economy tighten, what happens is, well, your credit cards now have a higher interest rate. So you're less likely to go out and spend that. So you're less likely to go spend it at the business. The business now makes less money. The business at some point is forced to lay certain people off because now they're making less, right? Because interest rates are higher. People can't spend. People can't go out and buy homes like they used to. So now you have a seller's market as opposed to a buyer's market, right? You don't have as many people buying houses, but you still have a bunch of people trying to sell their house. They're going to lower the price of their house, right? And that's how when interest rates are high, it just becomes tighter in the economy. That's how they can actually reduce the velocity of money. And the velocity of money is essentially, if I have $1 in my hand, how quickly is that going to leave my hand and go into yours? How quickly is it going to leave your hand to go into the next person's, right? When you raise interest rates like we have all throughout 2022, right? And let me look at the Fed funds rate, actually. Yeah, effective federal funds rate. This is going to look a little better. There it is. Okay. So, yeah, this is better. So you can see here, like, when we had the 2020 pandemic and we had the whole world shut down, well, what the Federal Reserve did overnight was they took interest rates from 2.44% all the way down to effectively zero, right? Because they had to stimulate the economy. The economy was shut down and they had to do what they had the power to do, which was control interest rates. So what did they do? They lowered them from 2.37 all the way down to 0.05. And from before that, you could see this time in like the 60s and the 70s and the 80s, right? Like the US industry was really strong, right? So a lot of people were saving back then. They had cash in the bank, right? At a certain point in time, right? In 1981, you could have kept savings that would have paid you 18% per year, right? And the law of 72, I think it's the law of 72, is divide 72 by whatever interest rate you're making or whatever return you're getting, and that's how long it takes you to double your money. So 72 divided by 18 is 4, right? So imagine keeping your money in a savings account that's risk-free and doubling that money every 4 years, right? Now, it didn't last, right? It didn't last, but the idea is that that's how that return kind of works. Now, from 1981 all the way through today, right? You can see that interest rates have just been lowered, right? And sometimes inflation gets really hot, right? If inflation gets really hot because so many people are out spending and buying, and remember, if more people are trying to buy my products, right? And say I'm in competition with a bunch of people, right? The cost of those products, because there's so much demand for it, is going to go up. As a business, I'm going to increase my price, right? Because there's all this demand. And then the opposite happens when there's less demand. I might lower my prices, or I might not raise my prices. But anytime we've lowered interest rates, it's stimulated the economy. Anytime we've raised interest rates, because we had to put the brakes on the economy. Okay. You lower interest rates, now we stimulate the economy, right? Now people can go and refinance their house. People can go and afford more things, right? They can afford more things. They can now afford the monthly payment on that car, right? And you raise interest rates, now you contract the economy. And that's why we have these cycles of booms and busts and booms and busts and booms and busts. And you could see here in 2007, right? We had that big crash in 2008. And what that did was it forced central banks all around the world to just completely lower the rate, right? And this is the cost of money. Okay, when you make money more expensive, less money is issued, right? Because the bank, your commercial bank, your JP Morgan, your Bank of America, they're the ones that are actually printing the money, right? And they're giving it to you on a credit card. They're giving it to you in the form of a loan. And we have what's called a fractional banking system, which means banks are going to hold my $10,000, but they're going to go and lend that out 10 times, right? So from my 10,000, now they've created $100,000. That's the fractional reserve bank. That's the fractional reserve system. And again, we lower interest rates, we stimulate the economy. You can see here, essentially from 2014 all the way to 2019, interest rates were being raised. And then we had the pandemic, and then they had to lower interest rates. And then from January of 2022, we saw a huge spike in the interest rate, which is what caused that terrible bear market that some of us had to sit through, right? Where Bitcoin crashed from 69,000 all the way down to 17, where the NASDAQ came down, where the S&P 500 came down, where, you know, some of the people here with 401ks, you probably saw your 401k get hit in that time span, right? Because interest rates were higher. And since then, you know, the Fed has eased off these interest rates a little bit. Okay, not a whole lot, right? Not where we were in 2020, but you can kind of think of this as like the Federal Reserve is always going to act late because they have these cards that they can play, and they don't want to lower interest rates if they see that everything in the economy is okay, right? Like they're looking at unemployment and it looks okay. They're looking at inflation and it's come down, right? So they're not really inclined to go out and lower the interest rates. But you have also Trump, who's in office, right? He's forced to refinance all of the debt of the U.S. government. The U.S. government, I mean, I'm sure you guys have seen, you know, the U.S. debt clock, right? It just keeps piling and piling and piling. And what this is it's all the debt that the government holds right? $37 trillion. Now, the government doesn't have $37 trillion to repay this debt, right? They don't have the money. So what are they forced to do? Well, what they're forced to do, and the reason why we've seen a trend of lowered interest rates from basically 1981 until today, is because, you know, up here, they're like, hey, we want to finance the US government. Let's raise $1 billion. Let's sell, you know, all these bonds that are going to pay 18% for everybody, right? So they sell a bunch of that here, but then in 10 years, it comes due, right? So here's 1991, 10 years later, and you could see rates dropped even sharper, right? Why? Because the US government has to go in and refinance, right? So they have to lower the interest rates because we don't have enough money to pay it back, but maybe we can refinance at a lower interest rate, right? And they've been doing that for a long, long time. And in 2008, you basically had the whole world refinance all of its debt because it basically came crashing down. It collapsed. The whole system collapsed. And then the same on in 2020, right? You had a whole bunch of industries get affected. And then we had a lot of inflation because they printed $6 trillion. And now the stock market's at all-time highs. People feel more rich. People go and spend more. When they spend more, inflation goes up. When inflation goes up, people get very unhappy. And it actually is how the US government and the central bank rob you, the middle class, of all of your savings, is through inflation, right? But they need inflation because if they can debase the money supply, right? If we look at USM2, if they can just print their way out, right? That's how they're going to keep kicking that can down the road. That's how they're going to keep kicking that can down the road. And they don't really care about you, to be honest, right? Like, they don't want your dollars to be worth more every year. They want your dollars to be worth less. Because if you know that your dollar is not any good in the savings, well, you might as well go and spend it, right? They want you to spend your money. I mean, currency inherently needs to be inflationary because that's what's going to allow us all to spend. I don't want to hold my money. I want to go and spend it. I want to buy assets. I want to buy Bitcoin. I want to buy stocks. I want to buy real estate, right? Imagine if the dollar grew in value, there would be no economy, right? And I know it's a little bit of an unpopular take that our currency, it's the way that the game is set up, right? I just want to play the game in the way it's set up so I can beat it. And the way that it's set up now is we're going to print this to infinity. 100 years from now, we're probably going to have $200 trillion printed. And you're just going to have to deal with it, right? But you can either adapt or you can get left behind, okay? Because anybody that's been saving money for any period of time over 10 years, you lost your savings. You didn't make more, right? Because the inflation is just out of hand. And now I want to take you to the next part of this, which is essentially what are interest rates like right now, right? When you look at the 10-year, which is basically the most popular bond, it's kind of been flat and sideways from 2022, right? So interest rates have kind of remained high for a pretty long time, right? Now, another thing for crypto, right? Because this is a crypto channel, this is crypto content. A lot of people here might be invested in crypto, in certain cryptos. Well, here's the thing, right? Bitcoin has been going up. It's been a Bitcoin bull market, right? We're at all-time highs. We just made a new all-time high today, I think. Or we got super close. Yeah, we touched 110,737. And you can see, I mean, it's just a matter of time before Bitcoin explodes higher. That's why I have my Bitcoin hat. Because I definitely think we're about to push up to new highs, maybe 150 by the end of the year, maybe 200 by the end of the year. So it's a crazy, crazy time. So for Bitcoin, it's been really good. I mean, Bitcoin has grown. It's being adopted by nations. You have corporate companies that are buying Bitcoin now instead of holding cash in their treasury, right? You had like, I don't know, maybe some people here know about MicroStrategy. MicroStrategy had billions of dollars sitting in reserves, right? Because they were a profitable tech company. They made a bunch of revenue and they had all this money in the treasury that they weren't spending, that they weren't tapping into. And they said, whoa, wait. So instead of holding cash, why don't we just hold Bitcoin, right? So they did that. And then what happened is their stock price started to shoot up rapidly. And what these treasury companies are doing is they're saying, hey, we're going to issue more stock. We're going to create more strategy shares. And all the money that we raise with that, we're just going to use it to buy more Bitcoin. And now you have a bunch of companies doing this. I mean, if we look at Bitcoin treasury companies, you'll see that this list is growing every day. This website, bitcointreasuries.net, is going to show us. And yeah, right here we have, currently MicroStrategy is holding 597,000 Bitcoin. They're always buying more. They've been the ones that have brought this immense amount of buying pressure into the market, right? Metaplanet, I remember reading an article. They used to hold 11,111 Bitcoin. Now they have 13,350. They claim that by 2028 or in the next 4 years, they want to buy 210,000 Bitcoin. They want to have 1% of the Bitcoin supply. MicroStrategy already owns 2% of the Bitcoin supply. You've got Mara, you've got Riot, you've got all these companies. You've got Tesla on here. You've got Coinbase on here. You've got, let's see who else. Get out of here. Nexon. Well, I don't know who Nexon is. I'm thinking Exxon, but not. But you have all these companies that are just going out and following the MicroStrategy playbook. And what these companies have seen is a complete explosion in their stock price, right? Because some pension funds might not be able to buy Bitcoin right now, but they can buy MicroStrategy stock, which holds a ton of Bitcoin on its balance sheet, right? So it's an indirect exposure, an indirect way to gain exposure to these to the crypto market, right? And you have this mass influx of institutional capital coming in and buying Bitcoin, right? And this is what's leading the market right now. But where the bigger opportunity is not in Bitcoin. It's actually in altcoins, right? Which is any crypto that is not Bitcoin, like Ethereum, right? Which if you look at the chart of Ethereum, you'll see it hasn't even made a new all-time high since 2021, right? It has not made a new all-time high since 2021. So this one's due, and it's a much smaller asset, right? XRP we saw explode, and I'm sure there's a lot of people here that own XRP, but even XRP struggled, right? You could see that it made an all-time high back here in 2018 of, let's see, $3.40, and it got close, but it didn't quite break that all-time high this year. Now, I do believe it's going to happen, but again, you've just had this, like, Bitcoin is the only one that's really making new highs. I think Solana, let's see Solana. Yeah, so Solana did make a new high recently, right? But it's also down 50% since then, right? Solana got completely crushed this year. It had a really nice, push up, made a new all-time high, and down it went, right? And now we're kind of on this road to recovery. But at the end of the day, the opportunity for us as investors to make tons of money, to make the same kind of returns that early people in Bitcoin made, is to buy the right altcoins, right? Like Ethereum, like XRP, like Solana. I personally grabbed some Hyperliquid. It's a newer project. But the thing is the timing for these, right? When we look at the entire market, I can go back to TradingView here. and I can look up a ticker called Others, which is the entire market cap of crypto, excluding the top 10, right? So it's basically the entire value of crypto is currently $3.4 trillion. When you look at all of crypto combined, it's $3.4 trillion. But then if you subtract, Bitcoin, which currently is roughly 2/3 of this, you subtract Ethereum and these stablecoins and XRP and basically the top 10 cryptos, it's everything that's underneath, right? It's all these different altcoins, Sui, Chainlink, which I'm super bullish on, Hyperliquid, my favorite AI coin, BitTensor, Tau. That's what this is, right? And you could see that even though Bitcoin is making all these new highs, altcoins have still not made a new high since 2021. And historically, altcoins have been the ones to produce the largest portion of gains in the crypto market. It's been altcoins, right? And we just haven't seen that. I mean, they've grown a pretty good amount, but they're only up 250% from their lows, right? Usually they go up way more than Bitcoin does. And with that, we need to identify what is going to move the altcoins, right? Why are altcoins not going up right now? Well, that's what I'm going to try to help you understand today. And now we're going to get a little more, let's call it boring, but I'm going to try to keep it as exciting as possible. Okay. This is the macro stuff that a lot of people, especially new investors, I'll call them amateurs. Wall Street calls them dumb money. This is the stuff they don't pay attention to that the smart money does pay attention to, right? Like now, if you looked at the price action today, the whole market went up. Stock market's at new all-time highs. Bitcoin, new all-time highs. Other cryptos maybe moving up. But at the end of the day, remember what we talked about when we talked about interest rates, right? Now, let me show you real quick a chart of interest rates overlaid on a chart of this other chart. And let's see when it loads. Yeah, there it goes. Right? So, is this right? Am I looking at it the right way? Yeah. So you can see here, right? In pink, these are our interest rates. And in white, this is the altcoin market. Okay, now when interest rates are low, okay, the altcoin market grew a whole lot, right? You could see how low interest rates used to be back here. And then when the Fed started raising the interest rates, right, altcoins fell in value. And they've grown and, they kind of started recovering, but they're nowhere near. And yeah, if you look at this interest rate chart, it looks almost identical to the chart of altcoins, right? It looks almost identical. But here's the problem. Interest rates are high right now. So what we have currently, and this is the $1 trillion opportunity I'm talking about. Okay, let me move this in here. What you have here is the sum total of money market funds. Okay, now this is a little boring, but essentially what this is everybody here who has a 401k, some portion of your 401k is invested in a money market fund, right? Or a lot of 401k providers invest your money into bonds, right? Because they're the safest investments in sliced bread. And we currently have just this huge wall, $7.3 trillion. And is that right? Is that trillion or is that millions? So when you have 7 million times a million, how much do you get? I just want to be accurate here. 7 million times a million. You have, $7 trillion. This is all money that's just parked, not invested, currently sitting and enjoying a measly 4.3% interest rate, right? 4.3% interest rate. Now check it out. What's going to happen when interest rates come down? What do you think this money is going to do? Is it going to stay? Now, instead of earning 4%, I'm going to earn 2%. I'm going to earn 1%, or God forbid, the Fed might cut interest rates all the way down to zero. This money is going to find its way back into risky investments. And that's what altcoins are. They're essentially risky investments. You had interest rates drop to zero, practically zero in 2020. And then what we saw, and this is the big macro piece, that while most were fearful and saying, oh my God, my 401k is almost decimated and this whole world is gonna, it's gonna come falling apart and COVID's gonna kill us all and I should go and sell all my stocks. The best investors were buying, right? Like the Warren Buffett, buy when others are fearful. What did the Fed do? They immediately dropped interest rates, which freed up all this capital. And now you're like, wait. So to get my risk-free return, you're only going to pay me 0.5% per year. Inflation is already 4 times that, right? So when interest rates are lowered, now what happens is money, especially big money, what it does is it says, all right, where can we go and invest this, right? Where can we go and invest this? And I want to show you real quick another look here at the United States Purchasing Managers Index. So basically what this is, which it sounds boring, but this is the state of the economy, okay? This is the state of the economy. And let's turn that off real quick. So basically what you have is you have this orange line that oscillates between 34, and it's gotten as high as 64. Okay. And essentially what the United States Purchasing Managers Index is this is a survey that the government sends out to all business owners, big business owners, right? And they're like, hey, how are your shipments this month? How are your supplies doing, right? Like, how is your revenue going? Are you guys hiring, firing? Are you buying more? Are your costs going up, down, right? Like, it's a huge survey that they send out to really big business people. And they get this number and they report it every month. And essentially, if this orange line is below 50, it means that businesses are struggling. It means that businesses are contracting. They're not hiring more. They're actually letting people go, and they're paying more for their goods and services. And they're just struggling. They're not expanding. They're not growing. They're contracting or remaining flat and constant, right? And what you can kind of see here is, again, right? Look at this. This is post 2008. They lower interest rates all the way down to zero, and I'll get this pink line back here, right? They lower interest rates significantly. This pink line comes all the way down. And then what happens is it has a little bit of a lag, but then businesses can now go and finance and borrow money and build back better, whatever. And if this orange line is above 50, it means the economy is expanding, right? There's more money, more people are happy, more abundance. And the stock market usually would go up, right? And then you have this period here from 2012 until 2014, okay? And this period was Bitcoin's first bull market, right? It was Bitcoin's first bull market, and it was when it went from about, $1 to $1,000 or whatever it did from 2012 to 2014. And then we had a contraction again, right? And the market went down. And maybe let me put over here a chart of altcoins again. That's the others market, and we'll see kind of how it correlates. Okay, and we'll see kind of how it correlates. Okay, so when this orange line is above 50, the economy is expanding. Interest rates are usually lower. If interest rates are lower, the economy is expanding, right? But then what happens is all this money that's locked up in treasuries, that's locked up in bonds, and these money market funds, as we call them, it now goes and it has a riskier appetite. They're like, all right, let me, I got this money. Let me go and invest it in something that's going to give me a better return than 0% or 2%, right? So the risk appetite goes up, and you see that altcoins also went up in that time. Now, when the economy contracts and this orange line goes down, that's when we saw our subsequent bear markets. It usually bottoms out, and then it starts its next recovery, right? And you can see here, this is 2020, right? The Federal Reserve, $6 trillion stimulus package. We're going to lower interest rates all the way down to zero. They stimulate the economy. Now, instead of contracting and everything falling apart, now we're expanding again, right? The economy is growing now. And boom, we had one of the gnarliest bull markets ever, right? This is when I made $1 million, was in this time right here when the economy was expanding, right? And I had my money invested in places like the stock market, crypto, and I saw massive returns on my investments. And then we had the economy contract again, right? And you can see this orange line has dropped and is now under 50, right? And what we've kind of seen is the altcoin market, okay? The altcoin market hasn't made, and I'm looking at the pink line up there, okay? I'm looking at this pink line, right? Look at how similar it looks to what's going on in ISM, right? What's going on in the state of the economy? The economy is not doing so well right now. Why? Because interest rates are high. Why does he keep campaigning on this thing of like, Jerome Powell needs to lower interest rates, because he knows that if he can lower interest rates, that's what's going to stimulate the economy to grow again, right? But Jerome Powell is looking at it like, yo, the economy is doing okay, right? Like inflation's not high, unemployment is not high, so I'm not going to, mess with it too much, because the last time they dropped interest rates all the way down to zero, right? In 2020, we saw all sorts of inflation. And that's why they had to raise interest rates, because they had to tame it. And now we're in this predicament where the economy is not expanding as it usually should be, right? It would oscillate in these cycles, and it was always shorter. These retracements were always kind of short-lived, and now we've kind of been in the longest lull that we've ever seen. Now, you might be saying, well, if that's true, why is the stock market at all-time highs? Why is Bitcoin at all-time highs? Well, because there's different things that we're looking at. We have the whole global economy printing trillions of dollars in this time, right? So when they're going to continue printing, they're going to push certain assets up, and it usually starts with the biggest ones. And then again, when we can lower those interest rates, then we can get to the next wave, which is, where the altcoins do well, when ETH can finally head to 10,000, when Solana can potentially cross 1,000, when Chainlink can cross $100, right? Like that's the moment, and those moments don't last long, right? Like they only last maybe a year and a half, right? These gains come in very short bursts. That's why it's important as an investor for me to get set up, for me to position myself before that wave comes, because the last thing I want is to be the guy that's buying high and has lost everything through this time, right? I don't want to be that guy. I want to be the one that buys better now, because I know what's coming, and I'll tell you what's coming. And now we're going to read an essay, okay? We're going to read an essay, and before we read an essay, we're going to read this thing real quick. Okay, so now what we've had is we have Jerome Powell, who's playing hardball, and we have Scott Bessent, who is the Treasury Secretary. So what Scott Bessent basically is he's a huge bond salesman, right? He's trying to finance the U.S. government. He's in charge of all the operations to fund the U.S. government. So he has certain things that he has in his toolbook to help raise more capital, right? And if you heard some interviews with Trump currently said, look, all the debt that we're buying right now, because he has like $8 trillion that he has to refinance this year, and they don't want to refinance it at these high interest rates because it's just going to cost everybody here more. The more interest that the U.S. pays, it means now they have to raise taxes, and that's a whole domino effect. But you now have Scott Bessent, who's like, all right, Jerome Powell, bring it on. What Scott Bessent just did is going to potentially unleash $5.5 trillion, that's with a T, right? And balance sheet capacity. How is this going to work? What he's doing is the federal government sets a limit, right? They set a limit on JP Morgan, on Bank of America, on all the big banks that you deal with on a day-to-day basis, Capital One, American Express. They give them a limit, right? They're like, hey, look, American Express, if you have $1 billion of reserves, look, we'll give you 10 billion to go lend out, right? We'll give you 10 billion to lend out. We'll give you 10 billion to have on your balance sheet, right? Or you can control this much money, right? They can go out and lend it to you on credit cards. They can print more money. Now what happens is these banks are all required to keep a certain minimum amount of their reserves in reserve, right? So like, hey, I have $1 billion. I'm only going to go lend out 10 billion, but I have $1 billion in my account. And say somebody came in and started withdrawing a whole bunch of money. Well, I would have to start closing down or raising my interest rates to balance it out, right? But what Scott Bessent did is there's something called the supplementary leverage ratio, okay? And this aims to ensure that leverage is a capital backstop for the banking industry as opposed to the binding constraint, okay? And essentially what this is it's saying, hey, banks, look, we're going to change. We're going to lower your SLR ratio. So what it's going to give the bank's ability to do is, well, if we have this big balance sheet and we were previously required to keep, let's say, this amount in reserve, right? This is a whole pile of money that we can't go and invest. We can't lend out. We can't buy U.S. treasuries with. But now Scott Bessent is saying, hey, look, we're going to lower this SLR ratio, which is going to free up your balance sheet to go have these banks lend more money out. And specifically, what these banks are going to do is buy U.S. treasuries with it, right? And essentially what this means is, and now I don't want to confuse everybody here, but the way that you get interest rates down is one of two ways. One, the Federal Reserve lowers interest rates, or two, you have more people buy bonds, right? When you have so many buyers, it actually lowers the interest rate. When you don't have a lot of buyers, well, now we're forced to, raise the interest rate because I'm trying to sell this thing that nobody wants to buy. So I have to sell it to you at a discount for what I bought it for, right? So I'm going to lose, but you're going to win, but your interest rate is going to be higher, right? So what he's doing is he's essentially going into the banking system and he's saying, all of you guys are, and this is not going to happen right away, by the way. This has like a 3 to 6 months before it really comes into effect. But it's you can see here, it's about, the rule could take effect in as little as 6 to 8 months. But what it's going to do is you could see all these big banks, how much of their balance sheet is going to be freed up as a result of that. And all of this money is essentially going to go find its way into treasuries. And if Scott Bessent can successfully get $300 billion to go and buy U.S. treasuries, well, he can effectively lower that interest rate, right? He can effectively lower that interest rate, which is this pink line. He can lower that interest rate because the big banks come in, they put a big bid on U.S. treasuries. It lowers the interest rate. Now you have more money from money markets that's going to flood its way back into risk assets, and money becomes cheaper, so more people are willing to go and take risks, right? And then another thing I want to point out here, and maybe I'll give it to you guys, some of y'all as homework, but there's a OG legend investor. His name is Arthur Hayes. He's like a little bit of an economist, and he writes these papers every month and a half. And he goes into like really deep detail, and he was really good at predicting the market was going to drop in the beginning of this year, and he also called the bottom. Like, he's been very dead on with his predictions on what's going to happen. And a lot of time in investing, you have to just find people who have a track record of getting it right, and listen to them and weigh their opinion well. Okay, so he writes this paper, and he, and this is also a disclaimer, right? Like, nothing shared here is financial advice. This is just my personal opinion. The article that we're going to read here is the opinion of Arthur Hayes, who's very smart, but again, he could be wrong. But you also have this other thing where we now have the Genius Act that's been passed. And essentially what the Genius Act is, who, Treasury Secretary Scott Bessent, he's super excited about it. Why? Because recent reporting projects that stablecoins could grow into a $3.7 trillion market by the end of the decade. That scenario becomes more likely with the passage of the Genius Act, right? What is the Genius Act? The Genius Act is essentially going to allow banks to participate in stable coins. Now, stable coins, right? Biggest buyers of US Treasury. If we look at the biggest buyers of US Treasuries, Tether, who makes the biggest stable coin that there is, okay? It's the number 3 crypto. What Tether does is Tether has bought $33 billion worth of US treasuries. They're one of the biggest buyers of US debt. And basically what they do is they buy these treasuries that pays Tether, 5% per year. They create stable coins. They mint stable coins that can then be spent inside of crypto. And they're basically treated as if it's a dollar, right? Like, they're backed by the equivalent with reserves that Tether holds, but it allows Tether to, instead of giving you a dollar bill, to take that dollar bill, invest it in a treasury that pays them 4%, give you a digital dollar bill, so they get to keep all the interest. They make the US government happy because they buy up all these treasuries, and you get a stable coin that you can spend. Now, essentially what the Genius Act is it's going to allow big banks like JP Morgan, Bank of America, Capital One, Amex to issue their own stable coins. And essentially, we're going to find a huge amount of capital come back into the US stock market. So now the major issue that the US Secretary Scott Bessent faces is the same one that his predecessor Janet Yellen faced. Their bosses, the US government, like to spend money without raising taxes, i.e. the US president, politicians, and it then falls on the Treasury Secretary to fund the government via borrowing at an affordable rate, right? Now, the bond sales team of the Treasury Department must engineer an issuance schedule that accomplishes the following. They need to fund $2 trillion worth of yearly federal deficits, because the US government spends $2 trillion every year, plus they have $3.1 trillion of debt coming due this year. So they have to refinance that debt, and they have to find a way to lower interest rates so then it's not as big of a burden, it's not as big of an expense to them. So that's what the Genius Act is going to allow them to do, is it's going to allow big banks to issue these stable coins, to buy more treasuries, to lower the interest rate. And what the SLR ratio does is it now allows banks to free up even more of their balance sheet to go out and buy treasuries. And again, when we see interest rates come down, which right now we have a very big storm coming for the treasury market, right? That's when all hell breaks loose in the market. That's when all of these assets go tremendously up in value. So their goal is to sell bonds in such a way that the benchmark 10-year yield does not rise above 5%, right? Like, they don't want interest rates to keep rising. The Treasury Secretary's job was easy when the Fed was conducting quantitative easing. So from the year 2008 all the way to 2022, there was something called quantitative easing. This is when the central bank would print money and just buy US bonds. When the central bank would turn on their money printer to go and fund the US government by buying their bonds, well, it kept interest rates low and it kept the economy growing. And at a point, they had inflation tamed and stuff. But after 2020, we kind of saw inflation tick all the way up. So they had to end the program. And now it's really, really tough, right? The third quarter of 2022 was rough. The chart below is the chart of the NASDAQ 100, and the 10-year treasury yield shows how as yields spiked, the stock market swooned, right? So as yields rose in this white line, the stock market completely collapsed, right? Because now you have more money leaving the stock market to go and enter treasuries that pay a risk-free return. I don't have to take any risk, right? Now check it out. This was really, really interesting. There are two pools of funds owned by the large too big to fail banks, ready and willing. If there is the requisite profit potential to buy trillions of dollars worth of treasury debt, they are demand/time deposits and reserves held at the Fed. Therefore, they will do what the government asks as long as there is some modicum of profit on offer. The BBC, Scott Bessent, requests they purchase his shitty bonds, and in return, he will shower them with risk-free returns. I believe the reason why Bessent is so pumped up about all things stablecoins, because this is a huge bill that's in Congress right now, is that by issuing a stablecoin, too big to fail banks will unlock up to $6.8 trillion of treasury bill purchasing power, right? Because now, and check this out, this is the stablecoin flow. This was so badass. Look, treasuries receive a full or partial exemption from the supplemental leverage ratio. So that's another thing that they're working with this SLR is like, oh, hey, your treasuries are going to be exempt from the SLR. So go out and buy as many treasuries as you want. We're not going to limit you anymore, right? Now, the risk to that is there was an event in 2022 or 2023 when certain banks collapsed because of over leveraging themselves. But check it out. An exemption means that a bank is not required to hold equity capital against its treasury portfolio. A full exemption means that the banks can buy treasuries with infinite leverage. And the banks want to because it's a risk-free return. The bank can print all this money, buy something, make 5% risk-free. So they're going to do that all day, any day. And you could see, and this is all of the reserves that are going to be freed up from, Bank of America, JP Morgan. I'm not sure what that is. Maybe Citigroup, Wells Fargo, right? And the Fed just voted to reduce the amount of capital banks must hold against treasuries. The first effects will be felt within the next 3 to 6 months. It is estimated this proposal frees up $5.5 trillion. By April 2023, losses on these bonds. Oh, this is him talking about what happened in 2020. So in 2020, you had all these banks buy up all these treasuries, and the banks that were not too big to fail, that were actually smaller, ended up collapsing because when they bought bonds at near zero interest rates and the Fed raised the interest rate, right? It made all of their bonds become essentially worthless. And now when you have customers rushing to withdraw their funds and you just don't have it because you invested it in these shitty bonds, you had a collapse. So by April 2023, losses on those bonds due to the fastest rise in Fed policy rates since the early 1980s caused 3 banks to fail within a week. In the too big to fail realm, Bank of America's losses on its held to maturity portfolio of bonds eclipsed its total equity capital. So essentially, the too big to fail banks, they've got like a backdoor with the Fed. Like they're like, oh, we're not going to go down. You guys are always going to backstop us. Check it out. JP Morgan recently announced its plan to launch a stable coin called JPMD. Now, this was so interesting to me. Check this out. So what is the benefit of banks having stable coins as opposed to these digital dollars that we all send and wire and cash and all that stuff? Check it out. I guess we'll get to it a little later. The second type of deposit is a stable coin, right? The first kind of deposit is your regular deposit. The second type is a stable coin. JPMD rides on a public blockchain, which in this case is Base. This is Coinbase's blockchain. Customers can spend their JPMD 24/7, 365 days a year. JPMD by law cannot pay a yield, but I imagine that JP Morgan will entice customers to convert regular deposits into stable coins by offering generous cashback spending perks, right? Like your credit card already does it. That's how they get you to get into debt. They're like, yo, we'll give you $50 back if you spend $1,000 on this. Check it out. Customers move money from regular deposits to JPMD because JPMD is more useful and the bank offers cashback spending. In total, the too big to fail banks have an estimated 6.8 trillion in demand and time deposits. Very quickly, because stable coins are a better product, regular deposits will be converted to JPMD or similar stable coins issued by other too big to fail banks. Why would JP Morgan go through the hassle of nudging customers to switch from regular deposits to stablecoin deposits? The first reason is cost reduction. And when I learned about this, I was like, this is why crypto is the way. If all regular deposits become JPMD, then JP Morgan can effectively eliminate its compliance and operations department. Let me explain why Jamie Dimon came in his pants when he learned about how stablecoins actually work. In aggregate, the too big to fail banks spend $20 billion per year on compliance and the operations and technology required to comply with banking regulations. This will be reduced to effectively zero by shifting all regular deposits into stable coins. These big banks are going to save $20 billion by converting them to their customers to stable coins. The second reason why JP Morgan will push JPMD is that it allows the bank to purchase billions of dollars worth of T-bills risk-free with the stablecoin assets under custody. This is because T-bills have close to zero interest rate risk, but effectively yield the Fed funds rate. Remember that too big to fail banks have $5.5 trillion of treasury buying capacity under the new supplementary leverage ratio. The banks need to find a pot of inert cash with which to purchase said debt, and the deposits held by the stablecoin are a perfect fit. So what about competition? Don't worry about that. The Genius Act that just recently came into legislation ensures that non-bank issued stablecoins cannot compete at scale. Remember, we're in the cabal of central banks and all these big banksters, right? They're going to make sure to squash as much of the competition as possible. The act explicitly bars technology firms like Meta. Remember, Facebook tried to launch their own stablecoin and it did not go successfully, right? Because the banks don't want stablecoins to be, in the hands of privately owned companies like Meta and Netflix or whatever. Like, they want to have the dominance on that market. They must partner. Like, if Facebook wants to launch a stablecoin, they have to partner with a bank or a fintech. That's what this new Genius Act says. Okay. And in return for the gift of stablecoins bequeathed by Besant, too big to fail banks will purchase up to $6.8 trillion worth of T-bills. If banks purchase that much in T-bills, they're going to drive the interest rate all the way down, like super down. It's going to allow the US government to refinance at a much lower interest rate. And what's going to happen is this huge wall of money that's in money markets is going to find its way into altcoins right here. And effectively, that's what's going to be the catalyst for the next big, bad bull run, right? We're not there yet, but this chart is only going to go up if interest rates go down. And another thing that we have, which I didn't even get to, is, you have currently Trump. He's already said this. He said, hey, look, the next, because the Federal Reserve, the chairman of the Federal Reserve is appointed by the president. Okay. So Biden reappointed Jay Powell during his term, and now Trump next year will have the opportunity to crown a new Fed chair. And he said, I'm not going to pick a chair that is not going to lower interest rates. I'm not going to do it. Like, whoever I appoint as the chairman has to lower interest rates, because Trump knows that if he wants to engineer the biggest stock, crypto, real estate boom that we've ever seen, we have to lower interest rates. So him in tandem with Scott Bessent, they're engineering the perfect storm to send this market flying higher. And again, if you even look at like a very mature market like the S&P, look, we're currently at all-time highs. We made new all-time highs today. Okay. It's a freaking bull market for some things. Other things, they're on a little bit of a lag because they're on the higher end of the risk curve. So again, guys, now that we're kind of drawing to a close here, the best opportunity that you're going to find in crypto is going to come from altcoins. Okay. But there's a way to do it right and there's a way to do it wrong. Okay. So if you guys are interested in learning more about the ARC, about our programs, we have a brand new website that we made with the team about a few months ago. Check it out. Get on there. Learn more about how you can involve yourself with a community who's talking about this 24/7. I'm staying on the ball. I want to surf this wave as best as I can. And right now we have a lot of opportunity. We have even just to get back to the all-time highs here, we're nearly doubling our money, right? Now you can do this by investing in just random things that you see and random cryptos that you can pick out of this list, or you could do it by getting into well-vetted investments with due diligence behind it and everything like that. Hey, what's up, Omari? Cool to see you on this. But yeah, guys, I mean, that's really what I have. I hope you can see what's coming. I mean, there's just so much money that's about to enter this space over the next 3 to 6 months. And the thing is the market is going to price all of this in ahead of time. It always does, right? So by the time that this can actually happen, the market's already going to be front running whatever that is. And that's why we're seeing even today, the stock market is hitting new all-time highs while currently crypto is lagging behind. And just to give you guys a little bit of a sneak peek as to what we're going to be talking about this Saturday, and this is inside of our community. But recently what we had was currently stocks just hit crypto. Okay. So now we actually have a way to buy stocks inside of our DeFi, inside of our wallets, inside of Ledger and stuff like that. We're actually teaching some really amazing but advanced strategies on how to provide liquidity with these stocks so that we can start making fees every time people trade between it. But I'm really excited because now I can buy Tesla in my wallet. I can buy Netflix. Well, I don't really own any Netflix, but I do have Tesla. I have MicroStrategy. I have NVIDIA. I have all these other stocks that I really do love and believe in. And now I don't have to keep them in somebody else's custody. I can actually hold on to them myself, right? I can hold them inside of my ledger, and I own stocks on this ledger now that nobody can take away from me. And we're seeing this huge institutional wave of capital that's going to come of money that's going to enter the space. And again, if we play this right, this is what's setting up this huge $1 trillion opportunity that, unfortunately, a lot of people are going to fuck up, as a lot of retail investors usually do. They usually fuck up the opportunity. They don't do it right. They don't buy the right things. They don't know how to take profit. They don't know how to do the right research. They don't have a community that they can share their experience with, right? And at the end of the day, we're probably not going to see this opportunity ever again, right? Like, AI will only come around once in our life, and it's already doing that. How much more innovation can really take place before we get to a level where stock markets don't matter, and you were either made it or you got left behind, right? Now, I don't want to get left behind. I want to be on the cusp of this wave. I want to make sure that I get as much value out of this as humanly possible, right? Jordan says, I have chills. I have chills too, man. But again, I want to. I could. And my students know this. I mean, I could go on for 2 hours talking about this stuff, and sometimes we really pull these Marvel credits, and I'll just sit there ranting. But I do. We are closed here. We're actually about 11 minutes over. So as Omari says, you know, there's exciting times ahead. There's incredible opportunity. I mean, this is changing the way of finance as we know it. The fact that I can now buy stocks in a 24/7 market. You know, the stock market's closed right now because it's July 4th. It's Independence Day. Well, it will be tomorrow, and then there's the weekend. But now I can go and buy stocks in DeFi whenever I want. And it's pretty badass. So again, thank you all for being here. I'm back in. I'm back. I'm back. I'm back. Whoops. Sorry about that, guys. I just left the whole studio. Now I'm back. But I'm just saying my goodbyes. I hope you guys enjoyed this time that we all had together. Again, come join us next week. I'll be back on to talk about maybe something else that we can all nerd out about. But I definitely appreciate all of you, and on to the next one. All right. Stay safe out there, and keep learning and educating yourself. All right.